Should we be worried about industrial production slowing too much in China?
No, because it's a natural development. If you look at the numbers, the consumer and the service part of the economy is the one that's growing and taking a bigger share. So this development of a slowing industrial index, for example, is something that we can expect, and that will continue to go forward.
So, Mark, first of all, are you convinced by the messaging that China has done on G20 on yuan, and will they actually have to put a lot more stimulus?
I think they're going to have to put stimulus because you've got a situation where in emerging markets, and particularly in Southeast Asia, there's been a slowdown. So they want to stimulate their economy. The biggest markets are in that part of the world. So I believe they will continue this stimulus program.
And on what we heard at the G20, do you believe them when they tell you they will not devalue yuan?
They are looking at a basket of currencies rather than the U.S. dollar. So I think they were referring to the yuan against the U.S. dollar, not against the basket of their major trading partners. So what you'll see is a pretty steady movement against the U.S. dollar downwards, but against their basket of currencies that they major trading partners, it won't be very big.
Mark, do you believe that China has improved in its communication?
Yes, I believe China is relatively open now, and they've done a good job in communicating. Of course, you know, being a command economy, sometimes it's very difficult for us to understand what the command is from the top. And now those commands are clearly laid out in the 10-point program of the third plenum of the Communist Party, if you read those. But the details is what is really important, and that is not revealed very, very transparently.
Given the volatility we saw in Chinese markets, are you still a buyer of Chinese stocks? Do you understand, or do you think you understand, what the exact end game from Chinese authorities is?
We're a buyer very selectively. This is the time in China, and in fact in all emerging markets, when you have to be very, very selective. So we are a buyer of select Chinese stocks, yes.
And what's your take on emerging markets? They're going through such a tough time. So you have people saying, look, but they're cheap, but at the same time, there's no growth coming in from anywhere.
Well, it depends on where you're looking. I mean, if you look at some of the real bombed out areas, I just came back from Brazil, for example, and people are really down and out. They're very sad. And that's a wonderful time to be buying when everybody is selling and everybody is very negative on the country. Brazil is not going away. They're going through a lot of reforms. So I think that's something to look at.
Right, again, because it's cheap, but we don't know whether the president will end up being impeached. There's so much political uncertainty that unless you believe that the political doldrums will be put to one side, then it may not be a good time to invest in Brazil.
There's no question in my mind that the political environment will change dramatically in Brazil. Now, it'll take maybe another year, but, you know, the markets move ahead of these kinds of developments, so it's something to look at. If you look at the situation in Argentina, for example, I was in Buenos Aires a few weeks ago, the mood has changed dramatically as a result of what the government is doing. And, of course, the market is doing very well.
What exactly do you want to buy in China around the world, Mark? You're the ever-optimist. There's a point where you must think, actually, look, this is going to turn badly.
Well, we love this time of the markets because things look so bad. It's usually the time to be looking at these bargains. And the things we're looking at are those strong consumer-oriented companies, companies that have a good market share, are growing their market share as a result of disturbances in their industry. They're buying their competitors are going out of business. Those are the kinds of companies we're looking at.
This is what, across the emerging markets or specifically in China?
Across emerging markets. Okay, and particularly in China, you're going to see this kind of development going forward. You've not seen much of it in China yet, but I think you're going to be seeing that as we go forward.
And Mark, you don't think there's asset bubbles in China, or that the outflows that we've seen from China mean that there's something a lot more sinister going on?
Oh, there's no question. There are a lot of people in China who would like to get money out. As you know, they're going through a very huge program to stop the corruption. And that results in money flows trying to get out. But on this other side, there are many industries that are doing quite well in China. So I think you have to pick and choose which are the ones you want to be in. And of course, the country is going through a major correction as a result of the downturn in industrial production and the upturn in the consumer area.
Right, a correction which investors are still struggling to exactly understand because they don't exactly know what the Chinese authorities are thinking. But you would rather play it through stock rather than currency?
Yes, that's right. I don't think the Chinese currency is going to result in a massive devaluation. There'll be a slow devaluation. The fact that they have lowered interest rates means that they're not that worried about the currency crashing down. And don't forget, they've got a lot of controls in place to prevent rapid outflows of the currency.
All right, Mark, thank you so much for joining us. As always, Mark Mobius there, Templeton Emerging Markets Group Executive Chairman. Mark Mobius.